Good day, everyone. I hope everyone is having a lovely day. Today we're going to be dealing with IS 16, also known as property, plant, and equipment. Okay, let's dive into the topic. Okay, first we need to know that what is PPE, right? PPE is held for use in production or in supply of services or for rental to others or for admin purposes and are expected to be used during more than one financial period. So basically, PPE deals with non-current assets, and we know that non-current assets must be held within the company for at least 12 months. So if it doesn't meet the criteria of either of these, it doesn't form part of IS 16, which is PPE. So before we can do an example, we need to first understand the principles of PPE, right? So we need to understand that what is a carrying amount, right? Basically, the carrying amount is the amount at which an asset is recognized after deducting accumulated depreciation and accumulated impairment. Then you'll find your carrying amount. You understand? So it basically cost minus accumulated depreciation minus accumulated impairment, which will give you your carrying amount. Depreciable amount, right? So basically, it is when, let's say, an asset is 100 rand, but it can only depreciate for like 80 rand, and then the 20 rand is the amount that you're gonna get when you sell the asset. So the depreciable amount will be the 80 rand. So as it says here, it is cost minus residual value, which is residual value is the amount that you're gonna get at the end of the useful life of the asset. So what can be included in the cost of PPE? First of all, you need to include the purchase price. Remember, the purchase price is net discount, right? So you can't recognize an amount that you haven't paid. It doesn't make business sense. Okay. Then you're going to include your installation cost, delivery cost, and VAT only if an entity cannot claim. But if they can claim, obviously you have to exclude it from the cost of PPE, right? And also you have to include your administrative expenses. Okay. So basically, you need to know another key concept that what is depreciation? Like basically, what do they mean by the word depreciation? Basically, depreciation is a reduction in the value of an asset over time due to wear and tear. Obviously, you can buy a car today and expect it after 10 years to be the same cost. Obviously, you have to take into account economic reasons, the wear and tear obviously won't be in the standing condition. Obviously, the technology would have been outdated. Things like that have to be taken into account, right? Therefore, that's when accounting, they give a vehicle a useful life. Maybe they could say the useful life of this vehicle is 5 years to its residual value or to a nil amount. Okay. So basically, another thing that you need to know is that there are three types of depreciation methods, right? Which is the straight balance and the diminishing balance method and the unit production method, right? So normally in a company, the straight line method is used. You'd find in some factories where they have leased a machine, they could use the production units method because that lease might be based on the units produced, right? Maybe the lessor might give the lessee 1,000 units to produce, then after the lease ends. But in 99% of the companies, you'll find that they use the straight line method because of the diminishing balance method. It is not practical to use in the real world, but we're just gonna have to deal with it today for the purpose of knowledge level. But yeah, I guess I'll see you guys on part 2.